Hey, welcome to Let's Talk Money with Money T and Simply C.
We will be discussing financial behaviors, past experiences, relationships, and more. We're going to show you how all those things play a role in your financial decisions.
Talking about spending plans, saving and investing, and identifying your behaviors with money.
All of these things will help you jumpstart your road
to financial freedom.
Living just enough for the city I'm living all my
Welcome, and thank you guys for tuning in to Let's Talk Money. I'm Money T.
And I'm feeling real blessed, Simply C.
All right now.
She's crazy. We want to thank Ken Lamont for joining us last week. It was some really good credit information. But this week, we want to let all that time be donated to our guest, Pierre Burris from Megastar Financial, big branch manager.
Yes. I'm going to kick it off, though, with a statistic.
Okay.
So I got this from real estate brokerage, Redfin.
Mm-hmm.
And it's about home ownership amongst Black people. Only 44% of Black families own their homes as of the first quarter of 2020, compared to 73% of white households. What about that?
Wow.
That's a crazy gap. And in Washington, D.C., that's the city that had the most Black households who were homeowners, and their percentage was 51%.
Black D.C. is real Black, too.
Real, yeah.
Yeah.
Yeah. True that. And then half of Black families in Birmingham, Alabama were homeowners. And so this was a major shift from 2012.
Oh, that's what's up.
Yeah.
Well, Pierre, welcome to Let's Talk Money. Thank you for joining us.
Thank you for having me.
Of course. Why don't you tell the listeners a little about yourself?
Absolutely. Like I said, my name is Pierre Burris. I'm the branch manager for Megastar Financial here in Kansas City and the Burris lending team. And essentially, I've been in the mortgage industry for 17 years now. Have 3 branches here in Kansas City and have loan officers all over town that are here to assist our clients.
Cool.
That's what's up. So let's just dig right on in, because we know somebody, maybe even that's sitting in the room, that is going to be looking into purchasing a house this year. And so just what advice would you offer this person regarding just even credit and just preparing to buy the house?
And that's where I would start at it. You know, you want to prepare. That's what I see a lot is people coming into looking at being a homeowner, and they just really haven't prepared for it at all. I think it's important to really know, where to start. You had mentioned the credit part of it, bank accounts. There's different things that you want to have in line prior to starting that process. It's really great to just know where your credit's at, to know what is showing up, to know if there's any type of errors, to let someone evaluate that. How I typically start every client is with a mortgage analysis. I want to do a complimentary, it's no cost, no obligation analysis, and let them know where they're at. If we can find out where you're starting at, then we can certainly find a way and a plan to get you to where you want to finish. But that's the key. A lot of people don't know where to start. And like I said, get that mortgage analysis, get with your trusted lender, let them look at your credit, let them look at your accounts, let them look at your job history. There's a lot of different factors that do play a part in being approved for a home.
So once you have determined all that's really good stuff right there. I like just helping people get where they want to be. So developing that strategy. So once you've gotten there, how do you determine what type of mortgage is best for that person?
So my approach, and I can't speak for everyone, but the way I've been doing my business over the time is that I like to put everyone in different areas, different boxes. Mm-hmm. So I try to look at every loan like if it was my own. What would I do? Because I've been doing this long enough that I know, which loan programs are best. That's what we should be as loan advisors and loan officers. We should be able to direct the client into the best programs that are available for them. So what I particularly do is find out their situation. Then I find out all the programs that they may be eligible for. And from there, I start deducting, the pros and cons of those programs so that we can come up with a few. We don't want to throw 10, 15 programs out there because there may be that amount of programs available, but they're not all good for that client. So we want to make sure we narrow it down, get the programs that are good for them. And then from there, we can kind of break down the pros and cons of those programs and see what fits their family's needs.
So is it a time where it's like too soon? Like, can you say, do you start a year in advance, 6 months in advance? When do they need to contact you?
There absolutely is no too soon. Anytime, if it's even a thought in your head, you might want to reach out and contact me because we can let you know where you're at. Like I said, I've worked with clients that, on the spur of the moment contacted me and they're like, well, I know I can't purchase right now, but I want to see where I'm at. And sometimes that client is ready to purchase right then and they didn't realize it. Other times it may take several years. I've had clients, honestly, that I've worked with over 2 years and still got them to their house. It was a goal that they wanted. They followed the direction, and we achieved their goal. It took a little bit of time, but now they're a homeowner and they're no longer paying rent and paying for someone else's mortgage.
Right. And then in speaking on that, a lot of times rent can be more than your house mortgage.
Absolutely. Absolutely. I see it all the time, daily, to where the rent that they're paying right now is much more, not much more, but more than the mortgage payment. But even the benefits that come with a mortgage, if it's equal to what you're paying in rent or a little bit more, you're now created an appreciating asset to where each year your home's going to appreciate in value. So not only are you making a payment on a home, because everyone has to live somewhere, you might as well make a payment on your own loan, on your own home.
Right. You're
You're appreciating in value over time so that you're actually achieving wealth through home ownership, because now any appreciation, any equity that you gain in that house is now your equity. That's your assets that you can use down the road, cashing out, buying a new home, children's college funds, whatever it might be. That's your funds. That's your income, your assets.
Because, these new apartment complexes that are going up, rent is like starting at 12, 13, 15, 16
and
Yep.
up.
Yeah.
Yeah.
And up.
$100 a month. And so compare that to like how much of a house can you get paying out that type of money?
Yeah, absolutely. It all depends on the program that you're looking at and, your down payment, your credit scores, your debt to income, all that stuff plays a factor. However, I like to use the $1,500 a month range because a lot of times people are paying that in rent. And, you can absolutely, get a $250,000 home and have a payment at $1,500 or less, depending on the program. And those are nice homes. There's many great homes out there in that price range. People just don't sometimes understand, or not necessarily understand, but it's more of a mentality that they think they can't buy a home.
Yeah.
So they never try. And that's what I like to encourage everyone. You need to see where you're at, because you certainly may be able to purchase right now, or you may be able to purchase in a year. But regardless of that time frame, it's available if we set up a plan and we follow that plan. And, I'm just a big advocate on people purchasing homes, because you want to have that asset. You want to own your home to where every month you're making that mortgage payment, but it's going to you. It's not going to your landlord. It's a big difference.
Right. And then when you hit 60 years old and you have a less income, you don't have a house note. You don't have to pay for a place to live, which frees up a lot more money to travel the world.
Let you get that in.
Yes. How about that? I would like to know your thoughts on the benefits of a 15-year mortgage versus a 30-year mortgage.
So I actually get this question quite often, especially now with the rate environment. 15-year mortgages are very, very low. Interest rates are in the low 2s on 15-year mortgages. And, up until actually about a few weeks ago, interest rates were in the high twos for 30 years. They're a little bit higher now. They just went up a little bit, but still very, very low relative to the market in the past. So as far as the 30 to a 15, it's going to be all about payment comfortability. That's really what I want to emphasize with each client is, are you comfortable having a higher payment to achieve paying off your home sooner? If you are, let's look at the 15-year, because the 15-year is going to have a higher payment, absolutely higher. However, you're going to get each month that you make that payment, you're going to get a higher amount of that payment going to your interest. So you're going to pay your house off a lot sooner. You're going to pay a lot less interest. It's not 50-50, but you do save. I mean, depending on the house, you can save hundreds of thousands of dollars in interest by doing a 15 over a 30. Now, sometimes the 30-year mortgage is just a better mortgage for the client. And like I said, the payment comfortability is a big thing. If, you're comfortable with a $1,500 payment a month, but you're not comfortable with a $2,300 payment or, $2,200 payment of the 15-year, what I tell the person to do is do your 15-year. Do your 30-year, pay your $1,500, but then pay additional principal to accelerate your payment so you can pay your house off sooner. And I can do those calculations for you to make you see exactly how much extra you need to pay each month to make it a 20-year or 15-year note. Sometimes that's better for a person because they're not locked into the higher payment,
right?
But they can make it when they can.
Right.
And if
life happens.
Absolutely. And it does happen sometimes. But if you can make $1,800 on that $1,500, 9 months out of the year, then maybe those 3 months, you make your regular payment and it still keeps you on schedule.
And I think that it's worth, getting the, seeing what the 30-year payment is versus the 15-year payment is, because from experience, it was only a couple $100.
Yeah, you just never know. You want to see what the difference is. I encourage, if you can do a 15-year, I definitely encourage everyone. But, there's different trains of thought. And what I try to do is I try to be an advisor to my clients. So if I'm hearing from them that they like to invest in the stock market or they like to place their money in other places, I might say, well, let's do the 15-year and then take your additional money that you would do on the 15-year and push that into your stocks. Maybe you're getting a higher return on that. Or if I hear, hey, real estate is where I want to be at, then I want to go to that 15-year so they can get that note paid off so they can be paying less interest. And maybe now they're going into a rental property to where they can, establish that. So, there's different ways of talking to the client and hopefully understanding exactly what they're looking to accomplish. And that's going to gear what mortgage is best for them.
So I want to go back a little bit, talk about how the percentage rate is figured, like credit worthiness, what determines how much interest rate, what the interest rate is for a mortgage.
Great question. So, and people call me all the time and they say, hey, I hear their interest rates are this. And I usually chuckle a little bit because there is no interest rate that is set for every person. Okay. If someone is advertising an interest rate, it's based on criteria. They may not tell us what the criteria is. It may be you have to have a 740 credit score with 20% down on the 15-year note. That's going to determine what your rate is. So it's all based on those factors. Debt to income, credit rating, credit profile, and loan to value, which just means how much you're putting down, how much your loan is going to be to the value of the home. So those factors come into play. So everyone actually is going to have their own interest rate based on their profile.
So let's kind of dive into credit scores and what that needs to be nowadays just to get into a house, and also down payments, like the percentage. Is it 3%, 5, 20? Like, what are we dealing with nowadays?
Yeah, for sure. So, as far as the credit goes, there's agencies that set up credit limits as far as minimum. So FHA, VA, Fannie Mae, Freddie Mac, they all have their minimum credit requirements. Now, this doesn't really mean anything because the investors then, the mortgage lenders come in and they have their own credit limits. So you can go around town and you can find different companies offering different minimum credit scores requirements. And they generally do not match exactly what the agencies offer. What I typically tell someone is you want to have a good experience with your loan. And from my experience, 17 years of doing this, if you don't have at least a 620 credit score, you're probably going to have a bad experience with your loan. Okay. There's plenty of companies out there that work below that, but you're not going to be happy. It's going to be a long, tenuous process. You're going to have to jump through a lot of hoops, and generally it's not a very pleasant experience.
I didn't know that they went that low.
Yeah, you can. Yeah, you definitely can. And you know, COVID has changed a little bit with the credit score requirements. They actually have come back down. They were up. There was many companies that were doing 680 was the minimum, but now it's come back down to most companies are doing 640, 620, and there's a few that do in that 600 or even possibly below that. Like I said, I would not recommend that, especially for a first-time home buyer, because it is going to be a tremendously hard experience for you, and the chances of you closing the loan aren't that great. So you just probably want to spend the time and actually improve your situation. That's why I do the analysis. I find out where you're at, and maybe you have a 600, maybe you have a 620. Even my clients that have a 620, what my goal is to continue to work on them, even though they qualify today, to get them into a higher credit score so that they actually can have a better interest rate and be in a better program and have the program go smoother along the way. Now, as far as down payment goes, now this is really across the board. There's differences. So you have programs that are 0 down, and you can put as much down as you want to. 0 down programs are very popular. So VA has a 0 down. There's nothing down due for the veteran. There's also some USDA, which is a rural development program. So it's basically on the outskirts of town. Rural areas offer that program with 0 down. There's also down payment assistance programs. Great programs in Missouri and Kansas for down payment assistance that can actually cover almost all of your required down payment. The standard agencies, conventional, they have 3% down. FHA has as low as 3.5% down. They're basically in tiers. So as you're putting more money down, it can improve your interest rate. It can improve your possibility of getting approved, because that's going to then in turn change your debt to income and change your overall credit profile. So, you can put, the 0 programs up to, some people put down 20% still. I don't have a lot of clients that do 20% all the time anymore, because the client is looking to put 20% down. They're looking to eliminate what's called PMI. And PMI is the bad word for everyone. A lot of times people don't understand the PMI, but they just know it's not good. They know they don't want to pay it. So once you put 20% down on a conventional loan, that eliminates your PMI. However, if you have a savvy loan officer, they're going to also know that you can put down 10, 15% on conventional and still eliminate that monthly PMI. So I do that for a lot of my clients, so they don't have to go all the way to 20%. FHA loans, they at this point have PMI for the extent of the loan. But we don't want to ever get that part twisted, because once you're a homeowner, the stats show that you're going to be moving about every 7 years. So if you're looking at PMI for the life of your loan, well, that's 7 years. It's not 30 years. You're not going to be going and completing that mortgage in most cases. You're going to be moving. So I tell people, don't be so concerned with the PMI. If you can get into a home and stop paying someone else's mortgage and pay your own, and you got to pay a little bit of PMI, it's okay. Because the next time you move, you're going to have that equity to use on the next home to put 20% down and not have the PMI. You got to start somewhere.
And then if you don't have that 20% to put down and you plan on staying in your home longer than that amount of time, you could like wait maybe 5 years or so and see if you come. Is it like the 80-20 type of thing?
Yeah. So
and then refinance?
Yes. So you can basically you have PMI. Say you put down 5% initially. You're going to have PMI until your loan hits 78%. That's when it falls off automatically on a conventional loan. However, you can always look a couple years down the line and see what your house is appreciated for versus what you owe, and then look at doing a refinance. Right now, in this market, there is a tremendous amount of people doing refinances because the houses are appreciating so quickly. Normal appreciation, 3 to 5%. That's typically normal, but we've been seeing 10, 15% appreciation a year, and it's been a crazy market. So people are buying their house and it's now worth 15% more, in just 1 year. So obviously if you put 5% down, your house is worth 15% more. Now you get that 20% gap so you can refinance and get rid of your PMI.
I was going to ask you if this was the season to do refis.
It is. It's just a perfect storm for refinances. Interest rates are low, appreciation is high. That's really what you look for. If your house is appreciating a lot and the interest rates are low, it's a great time to refinance. That like I said, it's a perfect storm. I haven't seen this environment. Like I said, I've never seen it. I've been doing it 17 years. I've never seen it where rates are so low and appreciation is so high. So it's a great time to refinance. If you haven't refinanced and, your rates are anywhere above 3.5%, you should just look at it. And there's a good possibility you can get into a lower rate or eliminate your PMI or go from an FHA to a conventional that doesn't have PMI. There's so many reasons to refinance. You should definitely speak to someone because like I said, the stock market's going great. I'm a big financial person. I'm a big investor. I like to help my clients. Well, if they want to get in that stock market, hey, maybe we use some of your equity, pull that out and get you invested in the stock market, guarantee some 7 or 8% returns, like that we've seen over history.
Right. Because, I do know a lot of people will use that equity to purchase homes, to rent,
Yeah.
So,
rental houses, whatever it might be, you should always be able to use your home as an asset and as a tool to increase your wealth.
Good
Buy
stuff.
a note. Buy a note.
Right.
Yeah.
Yeah.
That's awesome. Boy, you said a lot. Right. I just be like, I'm just sitting here looking at them like, man, for real, I need to call you because I need to refinance.
Yeah.
So
we can look at, like I said, everything I do is no cost, no obligation. You just need to find out where you're at, no matter if it's refinancing or purchasing.
So speaking of interest rate, do they still do the, is it ARM?
Do they still do them? They do ARMs. Now, I will be honest with you. I've done one ARM in 17 years.
Really? Really?
I just don't do a lot of ARMs. It's just typically the one I did was I knew the person, they knew they were moving. They knew they were leaving. And they knew that they were going to get out of that loan. The only reason I don't do the ARMs is right now you can honestly get a standard fixed rate just as good as any ARM. And it doesn't run the risk of that payment shock when it adjusts. Those adjustable rates. And, that was part of the 2007, 2008 mortgage meltdown is that everyone was in these adjustable rates because they wanted to get in these nice houses for this very low payment. And then when that payment adjusted, there's nothing they could do. They could not make the payment. Some people's payment doubled in 1 month. And it was just, crazy, and the market melted down. And, so there's some more restrictions that were put on since then. So, the ARMs are not very prominent at these times, but they're still available. Typically we can get a better rate.
Right. So they're not popular.
Yeah.
So
They don't make sense. And that's really what I typically do with the clients is I'm never going to tell you a program that doesn't make sense. I'm a direct lender. There's no reason for me to entice you to do a program that's not best for you. I'm not paid by the client. I am paid by the end investor. So my job is just to find you the best loan program so that you're successful in your mortgage and make that payment on time each month.
I really love that. Just that customer, that really is that customer service and customer first kind of thing. So,
if I can go back to credit, as far as inquiries and things like that on your credit, does it make a huge difference when a person is going to purchase a home if they have a lot of inquiries? I know it kind of has negative ticks to it, but
so there's definitely a myth about getting your credit looked at and getting hard pulls. So people like to say, is it going to be a hard credit pull? I get that question weekly. And yes, it's going to be a hard credit pull. There's not too many soft credit pulls, but what they're concerned in and what's been put into their mind, and this is typically done by unconfident lenders. Let's put it like that. Lenders that are not confident about their process and their service. What they'll tell someone is, hey, I'll look at this for you, but you don't want anyone else to look at it because that's going to hurt your credit. That is a straight up, strict lie. It will not hurt your credit. The agencies have built in a window that you can look at different mortgage companies, get your credit looked at, and it only counts as one inquiry. So I tell my clients, if you ever hear some lender or mortgage company tell you that, you need to run because they're starting off, being deceptive. So they're probably going to be deceptive throughout the process.
Wow, that's good to know.
Mm-hmm.
Yeah, absolutely. So you have this window, it's a 45-day window where you can look at your credit. It counts as one inquiry, not a problem. But even if you go outside of that window, your credit is not damaged by looking at your mortgage. You may lose 1 to 3 points, but you're going to get all those points back within 30 days. So you really are not hurting yourself. What people are looking at when they talk about that, they see their consumer credit scores. They're getting Credit Karma. They're getting My Free Credit Report, those type of things out there, which are consumer credit. They're very, very volatile, and they're not your actual credit scores. They're kind of a surface pool is what I tell people. So yeah, you might see 30-point drop from one of those, but really on the mortgage side, it may be 1 or 2 points. It's not going to be significant like that. So those systems are great. Those companies are great to monitor your movement on credit. But, I hear it every day. Someone's like, well, Credit Karma says I'm a 720. Well, honestly, on a mortgage, you're a 660. And that's where I got to qualify you off. So there's many times I got to send a credit report because no one believes us that we actually have to have a different, factor that we're looking at as a mortgage lender than what they see on Credit Karma.
That's a good one too.
Yes.
Because a lot of times when you do the credit cards, they'll offer that.
Mm-hmm.
And you are getting that all the time. We can go check your credit score. And so that's just like a fake.
Well, you know what? It's not a fake. It's just what they say. It's a consumer credit. So you want to look at that because you want to see movement. If something went down, then something happened. Mm-hmm. If it went up, then you're going good. So you want to look at the movement on it. Okay. So you can definitely pay attention to those, but don't think that's going to actually be your credit score that a mortgage lender is going to use because they will not. They'll pull their own deeper credit report.
Good stuff.
So I'm thinking about closing costs. What are the fees that are paid during closing?
Okay, so there's 2 different areas that are paid on the closing cost. One is your closing cost, the actual cost of the loan, lender fees, title fees, third-party fees, and then there's also your prepaid taxes and insurance. So you're going to have those 2 combined equal your closing cost. So typically, it's all going to be determined by the amount of the house that you buy because your tax and insurance are going to be included in those closing costs. So it's really not a number for the closing costs, but what you want to look for is high lender fees, origination fees, them putting points on the loan. That's what increases your closing costs. But you should everything should be pretty much standard. If you see something that jumps out, if you have a loan and you see the lender closing costs of $3,000, $4,000, well, something's going on with that. It shouldn't be in that range. A typical lender's fees are going to be anywhere from, $900 to $1,500 in there. Then you have your title fees and your third party fees. So you can kind of see that. So that's what I always tell people. Look for those lender fees. See if they're, way out of line. And that's going to give you an indication of a lender you can trust.
So Pierre, I have some questions about the points. I need you to explain that to me because I don't totally get it.
Points are a little bit confusing, because you hear the term and you just don't know what it equates to. So essentially there is going to be a par rate. So what a par rate means is a rate that doesn't cost the client anything. So to keep it simple, we'll just say 3% is the interest rate that's par under your circumstance that we're running through. So with that 3% par rate, there is no cost at all to get that interest rate for you as the client. Mm-hmm. Now, some people say, well, I like the 3%, but I'd rather have 2.5%. Okay. That is certainly obtainable, but that's when the points come into play.
Oh.
Discount points is really what it's called.
Okay.
Okay. So the discount point is going to be whatever it costs to get you to that 2.5%. It may be 1 point. It may be 1.25. There's just different factors that are going to be for each lender that's going to be in there that's going to show you how much it's going to cost to get you to 2.5. So say for this scenario, 2.5 costs you 1%. Say you're buying a $200,000 home. In order to go from 3% interest rate to 2.5%, at 1 point, you're going to pay $2,000 to get you down to that 0.5% to 2.5. Now, what you should be being shown is what does that 0.5% do to you in interest over the term that you're going to be in the home?
Right.
Because if it's going to come out to be much better than the $2,000, then it's a smart thing. Now, if you're going to be in that home 1 or 2 years, then you probably don't want to buy down because you're not going to have time to recoup that money. But if you're going to be in that home 7, 8, 9, 10 years, well, you're going to recoup that money, threefold. So it's important to just kind of know the circumstance when you're looking at points. Now, those are discount points. If you see points that are just being charged for no discount, that is origination cost. And those are just sometimes added fees that a lender would just add on to a loan. There are some companies around, I'm not going to mention any names, but some companies, and they're mainly internet companies, so their loan officers are not really loan officers. They're more order takers. So they didn't go through all the training. They haven't been doing the business long. They don't really understand it. So what they're doing is they're just taking orders. So the company sets their files up and they set up everything with 1% origination fee. So that means coming into this loan, before you do anything, you're already paying.
Wow.
To get there. So, those are the ones you want to avoid. That's what I was talking about before. You want to avoid the lender fees that you see that are juiced up for no reason. Now, if you're getting something out of it where you're buying down the rate and getting the points, you can do that. It's very important to deal with a transparent lender. And that's the biggest part, I would say, is make sure that they're being upfront with you. They're showing you what's going on. They're explaining, what this is for and why. Don't just be okay with fees.
So they're taking these fees or creating these fees or pumping them up and they're calling them lender fees, or what is it that a person should look for, to know that they're not being.
So it's definitely, yes, it's definitely the lender fees. The lender fees part. So the lender fees are grouped into what's called origination costs. So the origination fees are what you look for. And like I was saying before, the origination fee, lender fees should be somewhere, $900, $1,500, right around in that area. If you see them, coming $3,000, $4,000, $5,000 in lender fees, that there's some kind of points are being charged to get to there, because there's, the lender fees are going to be your processing fee, underwriting fee, fees like that. They're not that much, so you just want to look in the origination cost and see what that box is. And everyone should be provided what's called a loan estimate. That's what I tell everyone to ask for, because anybody can quote you anything. They can tell you what you want to hear. You need to have them show you the loan estimate. When you see the loan estimate, they're going to be truthful on that loan estimate, and that's going to let you see what you're actually getting.
Okay.
It's like, why people just can't be right?
Right.
I agree. It's in my opinion, lending is a relationship building institution. And, the thing I can say is I've been doing this 17 years and I only know a handful of people that have been in it as long as me or a little bit longer. And there's a lot of people in lending, but 2007, 2008, people got out, or they never learned how to build relationships and to be trustworthy. Right. It's great because at this point, I'm starting to see people's children that I bought their home, that I helped them buy their home. Now their children are coming to me, 10 years, 15 years down the line, and now they're buying a home. So that makes me know that I'm doing something right, to get referrals like that. And that's, my business is 100% referral. I don't do anything outside of referrals. And I think that's just because, I want to invest my time in showing someone, how buying this home or how refinancing this home is going to better your life and how we're going to use this to improve your finances. I think of the whole financial picture, not just the home.
You know what I think too, that they take advantage of the fact that you go to a signing and you have pages and pages and pages and pages of documents that you don't have a clue what's in these pages. And then you have someone say, this means blah, 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 sign here. Blah, 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 sign here. And who's going to, and if you do read it, do you know what you read?
Most people don't. And the business has improved. I will say that, there's new guidelines out that say that everyone has to receive their closing disclosure at least 3 business days prior to closing. That's important. When you get that closing disclosure, you want to go over it. You want to review it with your lender, make sure everything is right, and that it lines up to what you were told originally. And
Right.
like I said, I've been doing this a long time, and I got calls from people, from title companies saying, "Hey, Pierre, can you help this client because they just got the closing? They were with another lender and the loan has totally changed. What can you do?" Now hopefully, that's not happening anymore. Hopefully the lenders out there understand that we need to present everything correctly up front. And then the closing disclosure is really that last, last item that the client will see that should align with everything they were told. But I tell people, use your gut. If you feel like something's wrong, it probably is wrong, and you need to go ahead and ask questions or check with other lenders. Like I said, remember, getting your credit pulled again is not going to hurt you. So, don't hesitate on shopping around. This is the biggest item you're ever going to purchase in your home, in your life. So don't just take the first person that, your uncle or your friend or whoever told you about. If you feel comfortable with that person, great. But if you feel like you're uncomfortable, you need to move on and talk to someone else.
I like that. So I know with COVID, some things have changed, and T was talking about all the documents that you have to sign. Has anything changed with that and being in person and signing your life away?
Any
And your second child.
So the biggest thing for me, and this is really where I build a lot of my business, like I said, I'm referral based, is that I go to every closing. So I did go to every closing. COVID has changed that because the title companies now, it's starting to open up a little bit more, but for the last year, they have only let the signer come to closing. The lender can't come, even the real estate agent can't come, on purchases. So it does make it very difficult. Now, what I typically do is I sit in the parking lot and
Parking lot
Parking lot pimp.
Yeah. So I say, I'm here for, call me on the phone and then I'll see you when you're finished and with any questions, but that has changed a lot. We don't do everything in person like we were able to before. But the closing part of it is big for me. I love attending my closing. I love answering the questions, making sure there's no questions, but just being there to congratulate that person at that time, because that's a big monumental thing for them. So,
that's wonderful support.
It is.
Dedication, a dedicated mortgage lender.
And how
You tied.
he is. I'm like, for real, I want a card. Like, I got some things. I got some other questions. And then we'll have you come back to it. Maybe we can dig a little deeper into some of these things. I feel like it's spring, and usually when people start looking at buying houses, I guess when there's actually houses to buy, because we were talking about that too.
It is tough. Inventory is the lowest it's ever been. It's less than 1 month of inventory, which, to give you a perspective, typical market is like 9 to 12 months of inventory. We have less than 1 month.
Wow.
That is crazy.
That is. Is it a particular price range in homes or just across the board?
Just pretty much across the board. It's very crazy. I had a client that won an offer yesterday, and it was big. It was posted on Facebook, everything the agent did. That house had 23 offers in 2 days.
Jeez.
And, it was a $300,000 house, but 23 offers in 2 days. A client was lucky enough to win the offer, but that's the kind of market we're in. Is that it's definitely a seller's market. So, It's a little bit more difficult to get into a home, but it's a great time to buy still because interest rates are low. So you just kind of got to know that going in, and you got to be competitive, and you just got to go, make your offer.
And you got to be ready.
You definitely got to be ready. You got to be ready. Yeah, you can't go look at that house or go plan on looking at that house in 2 days because it's not going to be there in 2 days.
Exactly. Hey, thank you for all this valuable information. Why don't you give our listeners, tell them how they can reach out to you?
Oh, yeah. I'm easy to find. Like I said, my name is Pierre Burris, branch manager for Megastar Financial. You can give me a call directly, 913-238-1545. You can go to my website, P. Burris, Megastar Financial. You can email me, P. Burris, Burris, at Megastar, Megastar, financial.com.
All right, guys.
I had more questions.
I'm sorry. We're going to have to bring him back.
I'll come back anytime.
Dang.
Hey, I am Simply C. You can find me on Facebook and Instagram at Simply Custom Wood Designs. You can also find me at Simply Cupcakes on Facebook and also advocatingdaughters.com.
And I'm Money T. I am a travel advisor. You can find me on Facebook and Instagram, Priceless Destinations. I also have a website and a travel store, pricelessdestinations.com. And I have a Budgeting 1.0 course that you can find at Budgeting Behaviors, Facebook and Instagram. And also, if you guys are missing any of the past episodes, they are on YouTube at Budgeting Behaviors with T. So go there and catch all of our previous shows.
Hey, you're listening to Let's Talk Money. You can find Let's Talk Money on Facebook. Financial tips, some of the topics we've talked about. We also post the videos there. You can listen to us every Monday on the 8th.
That's 8 a.m. and 8 p.m. Central Standard Time
on BSB Radio. We out, y'all.